Happy Monday, everybody. Today is April 13th, 2026, and this is your Monday market update. Now, I want to start with a quick real world note. We spent the last several weeks talking about uncertainty, and last week was a perfect reminder of how quickly that can shift. One headline can move markets, one development can change sentiment, and yet, through it all, the structure matters more than the story. Let's recap last week's market and let's preview the week ahead. Now, as we start this week, futures are under pressure. Market following a sharp escalation over the weekend after ceasefire talks broke down. President Trump announced a blockade of the Strait of Hormuz, sending oil prices sharply higher and reintroducing geopolitical risk back into the market narrative. Now, at the same time, earnings season is kicking off, and Goldman Sachs, and while the bank reported strong headline results, the stock is trading lower on weaker than expected trading revenue. An early reminder that markets are going to be very sensitive to what's underneath the surface this quarter. So right out of the gate this week, we're seeing a combination of rising oil prices, renewed geopolitical tension, and earnings that are good, but not good enough, which does set a much more cautious tone compared to where we ended last week. Let's talk about that. Stocks moved higher for most of last week, driven almost entirely by one theme: geopolitics and oil. Specifically, the evolving situation between the US and Iran, and ultimately the announcement of a temporary ceasefire. And that one development drove nearly everything we saw. Now, at the start of the week on Monday, markets extended their recent gains as investors leaned into optimism that a ceasefire would be reached. Oil prices remained volatile, but the tone was cautiously constructive as negotiations appeared to be progressing. The Dow was up about a third of 1%, S&P up just under a half of 1%, and the Nasdaq was just up over a half a percent. By Tuesday, markets were far less certain. Headlines were mixed, rhetoric picked up, and investors were essentially waiting for that 8 p.m. deadline tied to potential escalation. Markets traded nervously through the session, but late day optimism around a possible last minute deal did help stabilize things. The Dow was down about a quarter of 1%, the S&P 500 up just a fraction, but the Nasdaq was up just a fraction as well. Then came Wednesday, and this was the defining moment of the week. A 2-week ceasefire agreement was announced, and markets reacted exactly how you would have expected. Oil prices plunged, one of the largest one-day declines in years, and stocks surged across the board. This was a broad-based risk-on move with some of the most beaten-down sectors leading the way. The Dow was up nearly 3%, S&P up about 2.5%, and the Nasdaq was up just under 3%. It's worth pausing here just for a second. This wasn't just about peace headlines. Oil had been driving inflation concerns. Remember this. And when oil dropped sharply, it immediately changed the inflation narrative, or at least in the short term. On Thursday, markets digested these gains. Ceasefire held, but headlines continued to come in, some positive, some concerning, which kept volatility elevated intraday. Still, the overall tone remained constructive as investors leaned into the idea that tensions were easing. The Dow was up about a half a percent, S&P up about a half of 1%, and the Nasdaq was up about a half of 1% also. Then on Friday, markets took a little bit of a pause. Stocks slipped modestly as investors evaluated the durability of a ceasefire and continued to monitor inflation data. Importantly, though, despite the slight pullback, the market still capped off its strongest week in months. The Dow was down about a half of 1%, S&P 500 down just a fraction, and the Nasdaq was up about a third of 1%. Weekly wrap for the week overall, it was a strong rebound. The Dow was up about 3%, the S&P 500 up about 3.5%, and the Nasdaq was up nearly 5%. One of the best weeks since late last year. Under the surface, the story was clear. Geopolitical risk came down, oil prices dropped sharply, inflation fears eased, and at least temporarily. So we saw that as investors rotated back into risk. But, and this is important, the ceasefire doesn't eliminate uncertainty. It just changes the type of uncertainty. Even with the ceasefire in place, oil is unlikely to return to pre-war levels because a geopolitical risk premium is now embedded in the pricing. And beyond geopolitics, the market still has to contend with inflation trends, Fed policy uncertainty, private credit concerns, and an ongoing question about AI-driven valuations. So while the bounce was strong, the foundation still needs to be confirmed. The week ahead shifts the market's focus in a meaningful way. First, geopolitics remains unresolved. While markets rallied on the ceasefire over the weekend, of course, there were reports that a more permanent agreement had not yet been reached. Negotiations are ongoing, and that means oil and inflation expectations can still move quickly on headlines. As I mentioned when I started, things seem to be escalating as we speak. Second, earnings season officially gets underway, and it starts with the banks. We'll start with Goldman Sachs to start the week, as I mentioned, followed by JP Morgan on Tuesday and Bank of America on Wednesday. And this isn't just about earnings beats or misses, as we already see with Goldman. Bank earnings tend to give us an early read on trading activity, lending conditions, corporate confidence, and the overall health of both the consumer and the business environment. So this week, the market begins shifting from macro headlines to fundamental confirmation, and leadership commentary matters. With Jamie Dimon already warning about a potential economic tipping point, markets are going to be listening closely. Third, now this is a very active week on the economic and Fed front. On the data side, we'll be watching PPI on Tuesday, industrial production on Thursday, and jobless claims for continued labor market signals. But just as important are the Fed speakers. We're going to hear from multiple Fed officials throughout the week, including governors and regional Fed presidents, and the message so far has been consistent. There is uncertainty tied to the Middle East and energy prices. Inflation progress has become less clear, and the Fed is signaling a more patient, wait-and-see approach. Some officials have even suggested that rate cuts could be pushed further out if inflation doesn't improve meaningfully. So while markets rallied last week on easing geopolitical tensions, the Fed is still very much focused on inflation risk, and that tension remains. Fourth, AI and semiconductor demand comes back into focus. We'll hear from ASML midweek and Taiwan Semi later in the week, both critical signals for the global chip demand and the broader AI trade. Fifth, the consumer remains a focus. Retail commentary is already pointing to more value-conscious behavior, which is subtle but important, which is a subtle but important signal that even as markets rebound, the consumer may still be adjusting to higher prices and ongoing uncertainty. Now, last week was about relief. This week's about validation. Do earnings support the rally? Does inflation continue to stabilize or reaccelerate? And how does the Fed interpret what it's seeing? Because markets can move quickly on headlines, but sustained moves do require confirmation. And all of that is, of course, all just to see what happens with geopolitics. So as always, stay focused on your plan, not the noise. Have a great week.